Let's stay on the markets, talk a little bit more about the setup here as we look to wrap up this first real full week of earnings season, let's call it. We're joined now by Chief Global Strategist over at Deutsche Bank, Binky Chadha. Binky, great to have you back on the program. Thanks so much for jumping on. I want to start with a note that your team put out, which I wrote about a couple weeks ago, this idea of how fast the cycle is moving and these sectors of GDP that are now above their pre-crisis trend. And I'm just curious how you guys are thinking about what the future of this recovery looks like for markets, given the breadth of the recovery that we've seen across industries so far.
Yeah, I think, the key message that one wants to take away is that if you look at, very sort of broad aggregate measures of economic activity, and you look at, for example, GDP, which is probably the most popular measure of aggregate activity, you're going to conclude that in Q1, we were still about 1% short of sort of pre-COVID levels. And especially if you look, relative to the trend in GDP, because of course GDP grows over time, there's still a 4 percentage point gap, and that suggests that the recovery phase back up to trend has a ways to go, and of course the cycle doesn't end there. We go the other side of trend, and all of that suggests the recovery has much further to go. But what is very, very unusual this time around, and it's a function of really the speed and the composition of the recovery, something that doesn't happen 1, 2, 3, even 3 years into a recovery, is that various components of GDP, especially on the goods side and part of the investment side, are way the other side of trend. And so, what does this have to do with the equity markets? If you map the same kind of way of thinking about things or where we are relative to trend into 53 industries in the S&P 500, the somewhat surprising and rather loud conclusion is that about 2/3 of the S&P 500 by market cap is well above trend, and about half of that 2/3, so about 1/3 of the S&P 500 is actually, in terms of activity levels, is about 5 standard deviations above the trend level. Now, this doesn't mean that we're definitely going to roll over. It definitely does mean, though, that growth and earnings growth and activity levels are likely to slow. And what I would say, looking both bottom up and top down, the way that the market's priced currently is sort of that we are very much in the early stages of recovery. I mean, if you look at the multiple on the S&P 500, we're trading at sort of 24 times. It's normal for multiples to be high in the early stages of the recovery, but a deeper look at the industry level of the S&P 500 suggests that the bulk of it is actually much later, and multiples and valuations should be a lot lower. You can see that some parts of the S&P, especially the parts that are below trend, those that are basically sort of at trend, are discounting as the market normally does. And as you go above trend, the market puts a lower multiple on them. But for the market as a whole, I would argue earnings are already elevated, and the market's trading at elevated multiples on elevated earnings. So it's not a good combination going forward.
And there you saw the opening bell on this Friday morning on Wall Street. Exponential Fitness ringing the bell. They're the owners of Pure Barre, Rumble, and a whole lot of other fitness studios. Some of the top trending tickers on Yahoo Finance right now: Snap, really a blowout quarter. Facebook benefiting from the strong quarters from Snap and Twitter. Twitter, third trending ticker on Yahoo Finance. DiDi's still under pressure, given a potential regulatory concerns. Intel, of course, too. Top trending ticker on the site right now, post earnings. Binky, why, we came into the week, the market sold off aggressively. We've seen stocks rally back. Why do you think the market has come back as quick as it has?
So, we've argued for some time that you should basically look for a significant and bigger pullback as basically macro indicators of growth peak. It's what's happened basically in every recovery about a year in. And if you look at things like the ISMs, they have peaked. But, what we've really seen is sort of the pullback on, or, the reassessment of growth or where we are in this cycle. We've seen the pullback happen basically across asset classes. and really the S&P 500 and the Nasdaq have been the exceptions. And here I would argue that basically, the U.S. 10-year yield arguably basically overshot to the downside, and as it did that, it sort of impacted, tech, which was basically, pretty beat up. So that combination has sort of, seen us basically move back up. But I would argue, we are in the middle of earnings. Earnings, generally see basically the market go up by about 2%, and there's never really, we can go up by less, we can go up by more, but we've never really seen, a big pullback during earnings season, unless there was a clear sort of outside exogenous catalyst, like we had some time ago with Chinese devaluation and the like. But barring that, it's clearly earnings have been very, very supportive of the market, and we are in the thick of earnings season. And so it is currently still supportive, basically.
And Binky, how are you thinking about the Delta variant right now and its effect or lack thereof on your growth forecasts? I mean, it seems the data that we're getting is that vaccinated folks, they may get it, but they're not likely to be hospitalized or become severely ill. But we are, of course, seeing places that are pulling back on reopening. Is that going to have any effect on growth?
So it's another version of kind of what we've seen, where basically we've had this split between the goods side and the services side, and we're waiting basically for the services side to get further along, basically the reopening and recovery process. So that might slow some, but I would say as far as the goods side is concerned, I mean, every lockdown has seen sort of a more modest negative impact. And so from a market point of view, I think that the market's going to continue basically to look through things. On the economic activity side, our economists basically see the risks, right now to the outlook as pretty balanced. Both, remember that for the last, several months, the main issue was really upside risk to the recovery, which is, as we talked about earlier, been happening much faster, basically, than most people expected. And so, some slowing in the cyclical trade, some pullback, like we've seen 10-year yields, many commodities. So I think, it has an impact on the composition rather than, a bigger impact on the activity of the markets.
All right, we'll leave it there. Binky Chadha, Chief Global Strategist and Head of Asset Allocation over at Deutsche Bank. Binky, always appreciate the time. Have a great rest of your summer. I know we'll talk soon.